In 1976, the stock market was recovering from one of the worst crashes it had seen in more than a decade. And in his annual letter to shareholders, Warren Buffett felt it was important to explain why Berkshire Hathaway owns so few equities. He explicitly laid out the 4 rules for his shareholders that any business must pass in order for Berkshire to consider investing. So what I thought might be interesting was to take those 4 rules and apply them to Nvidia, the world's largest company at the center of the AI boom, and ask ourselves, does it pass the test? And to be totally upfront with you and save you the time on this video if you don't want to watch, it doesn't pass the test. But I think what's really interesting is that it doesn't pass the test here, and it also doesn't pass the test here. And the reason for that is what's worth talking about in this video and worth understanding for us as analysts. By the way, if you're new here, welcome. My name's Christian. I'm a CPA and senior financial analyst, and this channel is where I think out loud about business analysis, whether it's from an investing perspective or lessons that I've picked up in my career. Or it might just be the books that I'm reading now and how they shape the way that I think. It's less of a pure finance channel and more of a place where we can learn together about markets and business analysis as a whole. So without further ado, let's just jump into it. Okay, so the first question Buffett always asks is whether or not the business has favorable long-term economic characteristics. Basically, is this business going to be more valuable in 10, 20, 30 years than it is today? So Nvidia is a hardware and software business in the AI industry. They create the chips that AI is trained on and are hosted on at runtime. And I am very far from an expert in this, but if you wanted to analyze it, you can look at Nvidia's customers like Anthropic or Microsoft or Meta, and you can look at the usage of AI itself. People are using AI more and more for computer and math and coding, education, office and admin support, agents are being created, etc., etc. And this is really happening all over the world. These are both graphics published by Anthropic, so you could maybe argue that there's a little bit of an incentive for them to sell their own product in these statistics. But at the end of the day, I think it's pretty obvious that people are using AI a lot and talking about it a lot. And what is irrefutable is that the hyperscalers are spending an insane amount of money on chips and on AI infrastructure. If you just look at this chart from Apollo, you can see how much money the hyperscalers are spending on this stuff and how it's obviously increasing insanely dramatically over time. It's a little bit worrying, I think, if you own these stocks, but at the end of the day, we're looking at this for Nvidia, and the result of it is that remaining performance obligations are exploding. I mean, this says it all in itself. This is essentially contracted sales for Nvidia that they haven't fulfilled yet. It's basically almost guaranteed future revenue for them. And that partially explains why the stock has gone up so much in the last couple of years. At the same time, I think it's important to acknowledge some of the risks here, because in the past, the semiconductor industry has been very boom bust over its life cycle. It tends to spike in demand and then fall back down. And over time, the trend is obviously up and to the right, and that's what you'd want to see. But if you're looking into buying a business at this time, valuation is important, and I would probably feel some reservation that this is going to not last forever. I think based on this high-level analysis, I would be pretty happy with the short term, I would be pretty hesitant on the medium term, and I would probably be pretty happy with the long term as well. I mean, it does seem to me like our civilization is just increasingly going to demand more and more computing power as technology advances and we advance as a civilization. So the businesses that are able to provide that will have value that they can charge for. But the more important thing is whether or not Nvidia has the moat that allows them to capture that value. So doing some light research, the moats that are most commonly cited for Nvidia is first and foremost CUDA. CUDA is the software layer on top of Nvidia's computing hardware, which allows developers to use the GPUs for use cases beyond graphics processing, namely AI. And this was really the insight of Nvidia to get on early. And because of that, not only do they have sort of first mover advantage, but it also has very high switching costs and network effects. It is the industry standard and tooling that students learn in university, and there's a learning curve associated with that. And that's really important because when you learn something in university and then you go enter the market, you want your employer to also use that as the standard, because that's how you're trained to provide value. And having having to learn a completely different tool set, even if it produces a fundamentally similar output, is time consuming and expensive. But more importantly, CUDA is also very much a platform where individual developers can create their own tools and libraries and share it with others. So that's that layer here, which a lot of the AI apps and frameworks sit on top of. That basically means it has network effects where more developers on the platform increases the value of the platform itself. Why would you go and you use a different platform for all your AI library tools when there are thousands or hundreds of thousands already on the Nvidia platform? It just doesn't make any sense, right? The other moat factor that I've seen is the relationships and supply chain that Nvidia has built and Jensen Huang has built over the last couple decades. Again, this is partly due to first mover advantage, but they have very long-term relationships with suppliers like TSMC, which is one of the true bottlenecks in chip manufacturing, and they have real capacity constraints. So being able to get preferential capacity allows Nvidia to be more consistent and reliable on their delivery times, which allows them to fulfill these orders that we discussed, as well as them fulfilling that orders leads to their customers wanting to place more orders with them. So there's a little bit of a feedback cycle there as well. So ultimately, I think between these and some other characteristics that you might want to look up for yourself, I would say that the moat does appear to exist, and that in turn gives Nvidia a lot of pricing power that you can see in their margins. I mean, in 2018, they had 60% margins, and that has basically just risen over the last 8 years to 75% gross margins. Gross margin is very often a proxy for pricing power, but being able to capture a 75% gross margin is a pretty good sign that your customers value your product specifically and don't want to go to competitors. So I think this rule is a hesitant pass for Warren Buffett's framework. Rule 2 of Buffett's framework is whether or not a business has honest and competent management. And to be totally honest with you, I think this is maybe the most difficult part for a retail investor like you and me to assess, because we don't have access to Jensen Huang. An institutional investor might be able to set up a dinner with him or even call him and ask him questions and get a real feel for his character. That being said, I think we have more options than ever thanks to social media. You can very easily go listen to him talk on stage at a keynote for an hour or two. You can listen to him talk to students at Stanford and the way he discusses how he thinks about the industry and the technology. You can go listen to him on pretty mainstream podcasts. Or you can, of course, go and listen to the earnings releases and how he talks to his shareholders and describes the business that way. And there are ways to judge a character. Do they come across as straightforward about the risks and the bad news? Or do they come across like salespeople trying to pitch their company to you? You can even judge them for how they dress or the car they drive. Are they flashy? Are they good capital allocators of their own wealth? I think at the end of the day, you need to keep in mind that this is a steward of capital, and if you invest, they are a steward of your capital. So do they seem like they take that responsibility seriously? I think for most mainstream companies that you look at, certainly those that are in the S&P 500, there is probably enough out there for you to form a pretty decent opinion on the CEO, and you can listen to your gut for that. I feel like Jensen Huang is pretty good. He has a great reputation, and I think he speaks honestly in his own opinion. And then in terms of track record, obviously Jensen is the CEO and the founder of the business, so the performance of Nvidia is entirely under him, and the chart pretty much speaks for itself. I mean, it's so insane. But I think more importantly, he made the bet on CUDA in 2007 is when they started investing in this technology, and it took 20 years for them to capture the weight of that investment. And I'm sure it was not easy at the time, right? If you're investing money in something for 10, 15, 20 years and nobody is really recognizing you for it, it's probably pretty frustrating, but he kept the faith. So I think you have to give him credit on being a visionary and being patient, and then having the operational excellency to pull off that vision and bring it into reality. That is pretty much irreplaceable and is 1 in a billion, and that is reflected in the value of the business today. The other thing you can look at if you're really keen is you can go look at sort of the executive compensation, which is pretty easy to find in the filings. If you look at Nvidia's, it's on page 38 of their most recent proxy report. And generally what they do is break down all the ways in which Jensen and the entire management team is compensated. I'm definitely not going to go through all of it in detail in this video alone, but really what you're looking for is that the incentive for management is aligned with the incentive for shareholders. And if you're a shareholder and you're planning on holding the business for a decade or 2 or 3 or forever, you want to make sure that the compensation that management receives is aligned with long-term value and long-term results rather than short-term. So typically what you want to see is that most of their compensation comes from equity of some kind, and then some of it will always be short term, but equity means that they are an owner in the business as well, so they want the same results as you. That's why it's important. And Nvidia has that. If Nvidia's stock price goes up, Jensen Huang and the management team get a lot richer than they would get if the price of the stock went down and they were just to collect their salary. So I think this rule is almost 100% a pass for Warren Buffett's framework. Okay, the third rule that Buffett always asks before investing in a business is whether or not the business price is attractive. You can't buy something for more than it's worth and expect to get good returns. That's pretty obvious. Now, one of my favorite tools for doing this is doing a reverse discounted cash flow. This is the opposite of doing a discounted cash flow. And I like it because it kind of strips out a lot of the arbitrary decisions you have to make when forecasting cash flows out 10 years. And it instead asks, what is the implied growth rate of free cash flows in the stock price itself today? What does the price tell us about what the market thinks the growth rate will be in the future? And then you just have to make one decision, whether you agree with it or disagree with it. It's quite a bit easier. So I won't go through the whole thing. If you guys want a video talking more about that, let me know in the comments and I'd be happy to do it. But I've ran a reverse DCF for Nvidia based on last 12-month earnings, a WACC of 10% and a terminal growth rate of 2% is about 19% growth, and you can pause the video if you want and take a look at the sensitivity of that. But that's more or less moderate growth, especially I think for a business like Nvidia that has just exploded in earnings in the last few years. It's really interesting. If you were to just look at the price chart of Nvidia, you would assume that it has some crazy baked in growth rate into it, but it's more or less pretty modest. So if you look at what that implies for the fair value, again, if the growth rate is higher than 19%, let's say 30% over the next 10 years, there's 100% upside. But if the growth rate of the free cash flows is only 9%, you would probably see around 50% to the downside there. So that's the quantified risk in my assumptions. Whether or not that's fair or reasonable, that's a decision you have to make for yourself. If you look at Nvidia's historical numbers since 2018, they've had a very wide and volatile swing in their free cash flow change. That being said, it's ranged anywhere from minus 52% to over 600% increase in free cash flows. And in the most recent year, it was around 60% growth. And again, that's a decision for you to make yourself. But for me, what I'm left with is actually what the last and final question Buffett asks is. And that is this an industry that you can understand? And I think this is the one that probably most of us get wrong the most. There's this thing that Warren and Charlie talked about a lot, which is the circle of competence. There are things that you know, there are things that you think you know, and then there's everything else that you don't know. And to be honest with you, I think we're all usually pretty poor judges of what we know, and we all probably know a lot less than we think we know. I think when it comes to Nvidia, for example, there are people in the industry that are genuine experts that have been in this industry for way longer than it's been popular, and they know it from the ground up. They know Nvidia, they know the technology, they know the supply chains, and they use CUDA libraries or applications every day on their job, and they see the value that it provides. And I don't do any of that. I'm just reading some things on the internet, and it is dishonest of me to not ask, what edge do I have on those people? What do I know that they don't know that is not baked into the price that's currently in the market? The reality is that I don't know how AI works. I barely even understand how computers work. It's basically just magic to me. And if I look at this image, I have no idea what this is. Do you know what this is? I've included it in here because it's nice to have pictures, but this is a chip, I think. That's about it. I don't know. If you know what it is, maybe you're better off investing in Nvidia. But the reality is that I don't understand any of this. I know it, but I don't understand it. And maybe I could get there in time, but by the time that I catch up to the market will have definitely already moved on. So, you know, Warren had this thing on his desk called the too hard box. And for Nvidia, it simply doesn't pass this test for me, and I would have to put it in the too hard box almost right away. And I'm happy to do that because really at the end of the day, I own Nvidia already through the index. It's the largest company in the world and it's 7.3% of the index. So for every $100 I put in the S&P 500, more than 7 of it is going to Nvidia, and that's certainly enough, but I'm happy to hold it in the index and apply my unique knowledge within my circle of competency to the businesses that I understand and have an edge on the market with. So those are Buffett's 4 rules that every business has to pass for him to invest in. And if you liked this video, I think you'll like this video over here. It's the key lessons and takeaways that I had from The Most Important Thing, which is a book written by another very famous investor, Howard Marks. So check that out, and thank you for watching.